All right, guys, let's quickly take a look at the upcoming FOMC policy decision and how we could potentially look to exploit this event. Now, one thing to just keep in mind about the policy decision today is coming into this week on Monday, I was of the opinion, as is the case for many other market participants, that the Fed won't have incorporated the CPI data that we get today into their summary of economic projections, into their dot plot. The reason for that view is because of the way that they normally vote, right? Normally those votes are tallied ahead of the time that we would have had or that we would get the CPI print. However, there's been some comments coming out recently, more specifically from Nick Timmerose, who's considered a Fed insider, as you guys know. And he's of the opinion that whatever we get today for CPI has the potential to change how a few of the members vote in terms of the dots, which suggests that they will have the information to incorporate that into the summary of economic projections, which is obviously different from the view that I had on Monday. So because this guy is considered as a Fed insider, and because he's got a lot to write on his, that rides on this from a reputational point of view, I'm going to assume that they will either be waiting for today's release like the most of us and then incorporating that into their vote, at least some of them, or I'm going to assume that they would have had this data released to them yesterday in order to incorporate it into their decision making, into their projection. So going into this meeting, I'm going to assume that they know what the CPI print is in order to adjust the dots accordingly. Now, to be fair, the way that I trade this will be slightly different as a result of it, but it just means that I'll be looking for a very clear threshold to trade this. Otherwise, I just don't think it's going to be worth it. I'll be looking for a very clear hawkish or a very clear dovish shift. Otherwise, I just don't know whether it's something that I'll be willing to risk capital on in a session like today. So that's just a quick heads up before we start with the official preview for this. Now, in terms of what we are looking for, it's important to understand what things will be included in today's meeting. Now, what we get once every quarter, for those of you who don't know, is the Fed's summary of economic projections, which is basically just the summary of where they see things like GDP, unemployment, PCE as their measure of inflation, obviously, and the federal funds rate will be going over the next couple of years. The most important data point in this entire data set, at least from a market reaction point of view, is normally what they have to say about the federal funds rate. And that is where the attention gets to the dot plot, the infamous dot plot. Now, for those of you who don't know what the dot plot is, every one of these dots, in the simplest terms, every one of these dots is a vote for one of the FOMC members, right? So let's just take these two dots. These two dots came in just below 5.5%. Let's call it 5.375, right? These two would be two members that voted and suggested, or based on their projection, they think the federal funds rate will be by the end of the year. So every one of these dots resembles what a particular FOMC member thinks the federal funds rate will be by the end of 2024, 2025, 2026, and the longer run will be their estimate of what we call R star, or the neutral rate of interest. So every one of these dots resembles a vote. Very, very simple. And what the markets normally focus on is the median of these dots. So how the Fed gets to these numbers over here, these projections, they take the median of all of these votes, all of these projections, and that tells them, based on their assessment, where the median view of the FOMC is for the federal funds rate to be by the end of the forecast years. Now, we've had Fed Chair Powell come out many times saying that please don't overestimate what we say in the dots. Please don't, take it as, as law, as written in stone. It's always going to be subjective, right? It's always going to be subject to change. Well, he said it a million times before. The markets don't care about that. They always react to the dots, which means we need to focus on it. If there's a big shift in the dots, the markets tends to react to it. That's the only thing we need to know. So the first focus point will be on the dots. Now we can see that with the last median for 2024, the last median for 2024 was at 4.6%. And we know at 4.6%, that suggested that the Fed back in March thought that based on their median projection, it showed potential for 3 interest rate cuts by the FOMC by the end of the year. Now, coming into today's policy decision, the consensus view believes that based on the recent data that we've had, based on the recent commentary that we've received from the Fed, they think that the median vote will shift from 4.625 to 4.875, basically moving from 3 cuts down to 2 cuts. That is the market's consensus view. Now, there's actually a few participants, outliers, that expect that to go down to 1 cut. There's even some expecting it to go to 0 cuts, but the consensus is expecting 2 cuts from 4.625 for the median to be shifted up to 4.87, going from 3 cuts down to 2 cuts. That's the consensus view. In terms of the other projections that we need to focus on, for things like PCE and core PCE, the prior for 2024 for headline PCE was 2.4, for core was 2.6. Now, broad-based consensus expects both of these to be upgraded from 2.4 for the headline to 2.6, and from 2.6 for the core up to 2.8. Again, that's the consensus view. Now, in terms of the forward guidance, that is expected to remain largely unchanged, because whether the Fed goes from 3 cuts to 2 cuts doesn't necessarily have to see any changes in those key statement points that the markets will be focused on. What are those statement points? The key focus points will be this one. In recent months, there has been a lack of further progress toward the committee's 2% inflation objective. Markets broadly expect that to remain unchanged. And they also expect this to remain unchanged, where the committee said the committee does not expect it will be appropriate to reduce the target range with inflation moving sustainably towards 2%. So that is expected to remain unchanged, and that would fit in with both the upward projections as well as the estimate of 2 cuts instead of 3 cuts. Now, in terms of market expectations or expected market reaction on the back of that, I don't see any immediate edge on trading an as expected or an inline outcome, just because it will surprise nobody if we get this. If everybody's expecting this to happen and we get exactly that, there's no edge in trying to exploit that, because nobody will be surprised. Having said that, though, if it is largely in line with the consensus view, and because that hasn't been enough to see any negative pre-positioning in equities, I mean, we've got the ES and the NQ trading at fresh all-time highs, with the markets expecting a slight hawkish shift for the FOMC. So if equities can brush off the expectations, the consensus expectations, then if we get a consensus outcome, that probably means that equities could continue their upside. That means that I would say, I don't want to say high conviction, the only decent conviction expectation that I would expect on a consensus outcome would be continuation of ES upside. Whether I would be willing to trade that is another question, and for that, probably not out of the event, maybe after the event, I don't know. But for now, I just don't see any clear immediate edge. But if we get that, it's probably going to be enough to just, it's probably going to be enough to feed into the current bullish fundamental outlook for equities. That's the bottom line. Now, if this is the consensus, what do we need to see then to create a clear dovish shift or a clear hawkish shift from the FOMC? Well, because we know the markets are expecting them to go from 4.62 to 4.87, basically going from 3 cuts to 2 cuts, for a hawkish shift, right? For a real hawkish shift, we would need to see the median go from 4.62 to 5.15 or higher. Basically going from 3 cuts, not to 2 cuts, but down to 1 cut. Now, like I said, there's actually 1 or 2 or 3 participants already expecting that. And there's 1 or 2 outliers expecting 0 cuts, right? So there is some hawkish outliers out there. But in my opinion, because so many, the consensus, if you will, is expecting 2 cuts. If we get 1 cut, that'll be a clear hawkish shift from the bank. That'll be them saying, hey, we don't think we're going to do, we don't think we're going to do 2, we think we're only going to have 1 cut. Now, keep in mind, if we take a look at interest rate expectations, the reason why I would not want to trade something like consensus at 2 cuts is because markets are very close to that. You know, at 40 basis points worth of implied cuts, it'll take either a 1 cut or a 3 cut dot to really shift the market's attention, going from, wow, we need to price out a lot here, or we need to price in a lot here, If we just get as expected at 2 cuts, we're so close to that. Yes, it could see a little bit of, dovish repricing, but I don't think that's going to be tradable because we're already at negative 40 basis points. We need to see the Fed coming out that forces this back up towards the high 60s, or that forces this back down towards the 20s in terms of projecting 1 cut. So just wanted to make that clear. So in terms of hawkish, we need 1 cut. And that also means that from a consensus point of view, because that's 2 cuts, for a dovish outcome, we need 3 cuts. We basically need them to leave the median. That'll be them leaving the median at 4.625. That'll be them saying that, yeah, based on the recent data that we've had, it doesn't change our view. We still think there's a likelihood that we cut 3 times. Now, why would that be seen as dovish? Again, the markets are only pricing in negative 40. If they say that we still expect 3, there's quite a big gap there between negative 40 and negative 75, which is what it should imply then. So a lot of repricing to be had, both hawkish and dovish there, if it's a 1 cut and a 3 cut. If it's 2, consensus view, I'll just stay put. What about the projections? We know the markets are expecting a 0.2-ish increase for the headline and the core PCE measure. So for a hawkish one, it needs to be higher than these, right? For a hawkish one, we probably need to see headline PCE closer to 2.8, and we probably want to see core closer to 3%. For a dovish, we don't need to see any changes. We basically just need to stay at unchanged. Because if everybody's expecting these to be increased, right, from 2.4 to 2.6 and from 2.6 to 2.8, if it's kept at 2.4 and 2.6, that'll be a very clear message that, yeah, we don't think there's more upside risk in inflation. If they leave it unchanged, that'll already be seen as dovish by the bank because everybody's expecting it to go up. Now, in terms of those statements on the hawkish side, they could say something like the following. Now, this is not going to be verbatim. This is me trying to explain what type of shift we'll be looking for, but it's not going to be these exact words, right? Don't quote me on these words. This is just me trying to explain what type of sentiment or tone they would probably want to convey. So we know for the unchanged, it's expected them to keep this line saying the committee does not expect it will be appropriate to reduce the target range with inflation moving sustainably towards 2%. So for a hawkish shift, they could potentially say something like this. The committee is open to adjust the target range either up or down as appropriate until it has gained greater confidence that inflation is moving sustainably to 2%. That'll be their way of opening the door to potential hikes. That'll be seen as super hawkish, right? If they go to 1 cut, or maybe even aggressive to 0 cuts, and they say something like that, that'll be seen as super hawkish by the markets, right? In terms of dovish, what can we look for? Well, we know this is the baseline estimate, unchanged. So for this part of the statement to change more dovish, recently they said, in recent months, there has been a lack of further progress towards the 2% objective. So they could come out more dovish. They could say, in recent months, there has been further progress toward the committee's 2% inflation. So if they remove a lack of and just stick to further progress, that'll be them saying, yeah, we think we're making good progress. What about the second statement? If they say something like, instead of the committee does not expect it will be appropriate, and change that to the committee expects it will soon be appropriate to reduce the target range, that'll be their way of saying, hey, we think a cut is coming. Their way of preparing the markets that maybe we do get those 3 cuts that we're anticipating. Again, all of this will be seen as dovish. In terms of market expected reaction, if we do get that dovish outcome, we would expect dollar downside, yields downside, equities and gold upside. For a hawkish outcome, the baseline expectation would be dollar up, yields up, ES down, gold down. Very simple. Now, in terms of possible trade scenarios, I'm going to stick to the exact same scenarios that I'm looking for CPI. If it's a clear dovish shift, I'll be looking for dollar downside as the simplest way to express this. I'll be looking for Kiwi dollar upside if that's the case. Alternatively, I'll be looking for T-bond longs and ES longs if that's the case as well. If it's a clear dovish shift like this, equities will probably love that, right? And T-bonds as well. So even though the dollar, I think, is the simplest way to express that outcome via, Kiwi dollar longs would be my favorite. T-bond longs or ES longs could both be attractive to look at. In terms of the clear hawkish shift, the exact opposite, right? We'll be looking for dollar... for a hawkish shift, we're looking for dollar longs as opposed to dollar shorts, and there my preference would be to look for euro dollar shorts given the geopolitical shenanigans we have in France right now. And obviously we've seen a huge blowout in those peripheral spreads. There's a lot of risk premium that was baked in. The euro continues to trade softly on the back of that. So if there's a strong hawkish case today, then euro dollar downside could be on the cards. The other one that we could look at is potential gold downside. The reason for that is just take a look at positioning. Positioning is, I mean, I can't remember the last time that I've seen gold this stretched in a very short space of time. The market's got super, super, super long, which seems like the worst possible time for them to do that, which isn't a surprise, but this just means I think there's more downside risk for gold than upside risk from here. And that means if we do get that perfect hawkish outcome, then gold downside, apart from euro dollar downside, could be attractive as well. Like we said earlier, if we get that consensus view, I don't see any immediate edge to trade this on that outcome. But, you know, again, look at pre-positioning. Equities have done really well despite the markets expecting a hawkish risk factor for the FOMC today. So if they are able to trade to all-time highs by already expecting a slightly more hawkish shift, and we then just get that slightly more hawkish shift, then there's no reason for equities to suddenly go down on the back of that, right? So this wouldn't be something that I would be too keen on trading, but I would expect a higher probability of equity upside on a consensus outcome as opposed to equity downside. But again, that won't be something that I would be trading with a lot of conviction. It's just my baseline expectation if we get an as expected print or as expected outcome. So that's just a quick preview for the FOMC. As always, any questions, don't hesitate to let me know.